Hey everybody, good to be here today. My name is Brent Moores. It's time for Friday. It is Friday, isn't it? It's time for Advanced Option Strategies, and we're going to continue our series of different option strategies each week. We're on week number 6. If you're interested in past weeks, you can always hit up the playlist for this class, and just go to the YouTube Trader Talks channel from Schwab, and you can find this class, find the playlist, and you can go back and see the first 5 sessions. Number 6, what are we going to do? We're going to do a strategy which I think is an absolutely wonderful strategy. That's not a recommendation, but it's an important one to know. I guess kind of 2 strategies: long synthetics, short synthetics. That's what we're going to be covering today. We talk about long synthetics a fair amount, not short synthetics as often, because, well, we'll explain why here in just a little bit. But I want you to get a grasp of both of those. And alongside me is Barb Armstrong. So she's helping me out in the chat today. I always appreciate Barb. She's a wonderful coach and good friend too. Appreciate Barb. And so between Barb and myself, feel free to type in those questions into the chat. We'll do our best to get those answered. Barb and myself are also on X at Brent Moore CS, at Barb Armstrong CS. Let's hit up a few disclosures and we'll get to the main reason we're here. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only and should not be considered an individual recommendation or endorsement of any particular security strategy or chart pattern. Schwab does not recommend the use of technical analysis as a sole means of investment research. Paper money application is for educational purposes only. For the sake of simplicity, I may not factor in commissions in all the trades we look at, but just realize those are an important consideration. All investing involves risk, including loss of principal. And let's see, short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And there's no guarantee of an execution of a stop order will be at or near the stop price. And of course, we'll be looking at individual stocks and option trades today. Those are not recommendations. They're just examples. And a good reminder from Wiley in the chat, Mother's Day, Sunday, don't forget it. It's important. Okay, here's what I want to do. First, I just want to start off, look at the markets real quick. I don't want to spend much time on that. But then what I want to do is I want to talk about the strategy that we're talking about today, strategies, I should say, that is long synthetics and short synthetics. And then I want to go to practical examples of looking at some example trades on those, okay? Hopefully that makes sense. And include talk about management of those. They're really pretty easy to manage, but we'll get to that. Here's the market. Where are we at right now? Basically break even today at this point. You know, obviously, we had the pullback. We came up, seemed like this was a relevant resistance level. We kind of hit up that level multiple times. We broke through, but then we came back down to it, bounced off it again, broke back, after the trauma of early April. Then we made our way back up, bounced off it there. We tested it both today and yesterday, but we haven't closed above that. So I would think that would probably be a significant resistance level, an important resistance level, I guess, to get above. Some traders, when they're looking to enter a trade, say from the long end, a bullish end of things, they'll just go, hey, look, if I break above, I'm golden. Some traders will take that approach. Some will want it to stay above that level for 2 days, 3 days, 4 days, I don't know. You can pick a level or a certain amount, 1% above or something like that. There's a lot of different approaches in the market. And you have to decide, there may be some stocks that you're long on, that you're bullish on, and you would want to do a bullish trade on. And there's maybe some stocks in the market out there that aren't really going up. Maybe they're going down, and you want to do more of a bearish trade. Well, the strategy we're going to talk about today can fit either of those, because I want to talk about synthetics. I'm calling them synthetics. These are technically stock synthetics. And I will explain to you in just a minute why we should be a little careful when we say stock synthetics or synthetics, because there are different kinds of synthetics out there. that you can use. But basically, what a synthetic is, so we're going to call this we'll go stock synthetics, okay? And so I'm going to do what I've done in past weeks, and that is just kind of do quick data dump, then we'll go to examples of those. But in the first one, in the case of a long stock synthetic, what synthet? I think I spelled that right. It's a long call. It's a short put, and they're going to be the same strike and same expiration. I'll abbreviate EXP, expiration. And so kind of weird, right? Why do we call it a synthetic? What's a synthetic? A synthetic is a substitute for something else. It's meant to mimic something else. Let me give you an example here. I'm going to go to the Analyze tab, and I'm going to go to TTD, Trade Desk, okay? The Trade Desk, I guess, is technically what they always have the there in front of that, the Trade Desk. Big earnings, okay? Big breakout on earnings. It was kind of flirting with that 50-day before. And yesterday, look, we're up 17% today. Wow, going bonkers. Okay, but here's what I want to do. I want to go to the Analyze tab. I want to go to Simulated Trade. Actually, I don't want to do that. I want to go to Risk Profile. And let me just move this up. And you guys are familiar with this risk profile. What does stock look like on the risk profile graph? For those of you who aren't familiar, on this graph, this shows profits or losses. The zero line where I'm drawing right now is break even, okay? If you buy a stock, we're going to say buy a stock right there, and the stock goes up. Here's the underlying stock price down here. I'm putting little dots down there. If the stock goes up, you make money on a stock. If you buy stock, it goes up and up and up. The more the stock goes up, the more money you make. If stock goes down, the more the stock goes down, the more you lose. Eventually, you'll hit the stock at zero, but that would be a substantial loss there, right? Okay, so that's just long stock. That's just buying stock. But here's what I want you to do. I want you to look at this graph. Look at the purple line. You know, kind of we're going down to the minus 1,000, up plus 1,000. Here's our break even. Here's the slope of the line. Now I want to show you a different trade here. Okay, here's the different trade. See if you can see the difference here. There we go. Okay, that's a completely different trade. This is not a stock trade. Down to minus 1,000 there, positive 1,000 there. There's our break even. It looks almost identical. That's why we call it a synthetic. Instead of buying the stock, you can buy a long call, you can sell a put, same strike, same expiration, and you end up with a profit loss graph that looks virtually identical. Okay. Now, it's not identical totally. There are some differences between long stock and synthetics. We'll get to that in just a sec. So it's not the exact same, but the profit loss graph is going to look about the same. Okay. What about short stock synthetic? Well, you know, sometimes when we're trading, it is, you know, we kind of maybe have this bullish bias, or we tend to think bullish when we trade. I think most traders are like that. I'm that way. But, you know, there are bearish traders out there. And you can end up mimicking, in a sense, short stock with short stock synthetic. Okay, same strike, same expiration. Let me give you an example of that, and then we'll go forward. Okay, and so this example, I kind of have a prefabbed example in here for you. I'm taking a stock. In this case, that maybe for a lot of technicians, they may say it's kind of bearish. Okay, it's kind of bearish. The trend is going down. That trend could break, of course, but that's like the number one thing a lot of technicians look at is that general trend. So I'm going to take a bearish look at this one here. Okay, well, let's do that. Let me go to the Analyze tab. We're on Amgen. Here is short stock. Now, we don't talk about short stock a lot in this class or any of our classes. And the reason is there is a theoretical unlimited loss with short stock. And I'm not talking about short stock today other than the fact that we're just relating it to what we're going to do with the short synthetic here. But there is a commonality between short stock and a short stock synthetic, and that is you have a theoretical unlimited loss. In other words, the more the stock goes up, here's the underlying stock price, the more that stock goes up, what's happening to that line? Well, in this case, and for the short stock, it gets worse and worse and bigger loss. And we could keep on, I could sit here all day long and scroll over and just keep on doing this. And that loss is just going to look worse and worse and worse. Okay. And so that's the reason why we typically don't teach short stock in this class. Okay. But here's what I want you to do. I want to look at this graph. Here's my short stock. That would just be selling 100 shares of stock. Now compare that to this graph. There's my short synthetic, okay? It's the same thing in terms of the PL graph almost. I mean, there may be some minor differences, but it's basically the same thing in terms of the P&L graph, okay, on these, the risk profile graph. So so if you're more bullish, you may do long stock synthetic. If you're more bearish, you may do a short stock synthetic. If you're bearish and the stock goes down, if you have that synthetic, you make more and more money. Okay, so let's go through and I'm going to continue to talk about these, but let me just mention this. Little side note, and I'm not going to actually write on our short stock synthetics rules here on this, but let me just mention this. And this is something that some of you may not know. Even some of you who are more experienced may not know this. There are other types of synthetics other than just stock synthetics. So for example, you could do an option synthetic. In other words, you can do a synthetic long call. If you want to do, I'm going to abbreviate long call just to make it a little easier. Long call, if you do equals, if you do long stock and a long put, and you look at the risk profile graph of the long call, and then you look at the risk profile of the long stock and the long put, they're essentially going to be the same thing. Okay? So let's do another one. What about a synthetic short call? Could we get something that's similar here on this? Yeah, if I do short stock, so I short some stock, and then I add a short put in there, short put, do you know what I end up with? I end up with a synthetic short call there on that. So these are kind of more unusual type synthetics. Can you do the same thing for long puts? Yeah, you can create a synthetic long put. And I'm kind of just writing this in because this is not as important and something, these are trades that you just hardly ever see in terms of explicitly stated. So I don't want you to worry about remembering these that much, but I think it's maybe of interest to you. And you can practice this. Have some fun, practice it. Take some short stock, add a long call to it, and see if that graph does not look the same as the graph of a long put. Okay, it's going to look the same. Okay, and let's do one more. Could I do short put? Yeah, you could do a synthetic short put by doing long stock and a short call. Okay. These are all alternative synthetics, but what we're focusing on today are these stock synthetics, number 1 and number 2 on my list there. Okay, so there we go. Now, question in the chat. So from Teofik, okay. Is this document available? No. If you want to take notes, you can. If you want to do a screenshot, you can. You're welcome to it, but I can't publish it. Okay. So let's talk about this. So these are directional. Long stock synthetic, short stock synthetic is directional. It's the same way that long stock is directional or short stock is directional, right? If you know, one of the differences here between these synthetics and actually buying stock, for example, what's the difference between long stock synthetic and buying stock? Well, number one, it's not stock. Now that doesn't help you much, but there's no dividends, okay? You don't get paid a dividend if you have the synthetic, okay? Maybe you find a stock that pays a nice juicy dividend. If you have a long call and short put, you're not getting dividends out of that, okay? And there's an expiration date. With stocks, you don't have to, you don't have to worry about that, okay? You don't have to worry about expiration dates. So those are a couple differences between buying stock and doing a long stock synthetic there. Okay? So that's something that I want you to know there. In terms of, what about your option Greeks? We always talk about option Greeks in this class, right? Every week we talk about option Greeks. What about theta and vega? They're basically neutral because your long call is probably they're going to be the same strike, same expiration date. Your long call theta is going to offset the short put theta. Okay. The long call vega is going to offset the short put vega. And same thing with the long put and the short call. So your theta and vega are very neutral. So in that regard, it is similar to stock, because if you buy stock, you're not having to worry about time decay or implied volatility, issues there on that. Okay. So that's your theta and vega. So in that way, it's a little bit easier. How long do you buy for? Well, what expiration date you choose. So with expiration date, as long as you plan on being in the trade. Now, if you say 10 years, well, we probably don't have an expiration that far out, but there are leaps out there on a lot of stocks. So you can go out a long period of time if you want. Typically, trade at the money contracts. Technically, you don't have to. You can play with it. Typically, in this class, what we do, in the classes that I teach, typically we demonstrate with at the money contracts. Okay. Let me just double check questions here before we move on to the next few items here on the list. Let's see. Where's the protection on our short legs? Ooh, Frankie, good question. Where's the protection on our short legs? Well, remember, this is a great question. Look at this. Long stock. Let's think about long stock. Where's your protection if the stock goes down? You don't really have any, right? If I buy a stock for $50 a share, it can go down to zero. I don't really have protection. If I short stock, I showed you earlier, we have that theoretical unlimited loss on that. There is no protection on the short legs. So now, could you alter this trade? And in addition to the short put a long put at a different strike? Yeah, you can, but that's an add-on to the trade. And on the short stock synthetic, in addition to the short call, could I do a long call at a higher strike price? Could I? You could, but again, that's not a synthetic, that's an add-on to a synthetic in that case. So it's a good question. Frankie, I appreciate the question, but there is no protection on those, which is a reason for the next item here on my list. And this is going to be Schwab option approval level 2, which means a lot of you will not be approved for this trade. I'm sorry. Okay. But it's an advanced options class, folks. Okay. We get into trades in this advanced options webcast that some of you will not be approved for. So just be aware of that. You need to be approved for options, and you need to be approved for the appropriate level of options there on that. Okay. So that's that. So here's the thing. Here's one of the differences between this. Upfront cost near zero upfront costs in terms of just dollar amount. But there is a buying power effect, okay? So you can't just endlessly do these trades, right? It will reduce your buying power every time you want to do one of these. And there's significant leverage here on this trade. You know, if I think of a stock and I buy that stock for $50 a share, say 100 shares, so that's $5,000. And that stock goes up 10% from 50 to 55, that investment goes from, and I'm just, I'm not factoring commissions here, 5,000 to 5,500. If this initial cost is basically essential zero or, very minimal, again, we do have a margin requirement of some sort on this, and the stock goes up, we're going to see the similar gains there. So still about a $500 gain. But you see the difference there? There's a much bigger upfront cost on this. So in terms of percentage of initial investment, it is going to be very significant. That's why I say leverage on these. Okay. Again, it's an advanced options trade. You have to be willing to be more comfortable with some risk on this. It is going to move like a stock in that regard, in the sense that if the stock goes up $5 a share, your synthetic would move about $5 a share on that. Okay. It moves, supposed to be plural, moves like a stock. All right. And so consequently, what you're going to do is you manage like a stock. So when I say manage like a stock, what I mean is for exits, likely going to put in stop losses. And for a long synthetic, stop loss would be below support. That'd be for long. For a short synthetic, it would be above resistance. That'd be for short synthetic. Okay. So that's kind of typical management there on that one there. Exit, even if you haven't hit your stop loss, but you have a technical breakdown. So in other words, just like a stock, if you were bullish on the stock and you turn bearish on it, you may decide not to stay with the stock. Or if you're doing a short stock and you were bearish on it, but it starts to go bullish, you're going to have an exit. It's very important to have exits, folks, in mind. And the reason is this. Let's say you get a stock. Let's say you do a short synthetic, okay? And the stock starts to go up. Well, we don't want it to go up, okay? We don't want it to go up. But in your mind, you look and you see your portfolio starting to lose money. And you go, well, I just think it's going to come back. I don't want to realize that loss. That's a loss aversion. I don't want to actually realize that loss. So I'm going to hold on and wait for it to come back. And then what happens? The stock goes up some more. Oh, now I'm really in a hole and I really don't want to realize that loss. I don't want to take that loss. So I'm going to wait a little bit more. And you know what your mind does? Your mind can talk you into staying with it longer and longer periods of time. So that's why you have to have your exits in mind before you trade there, before you trade. Okay, Let's go and let me just finish this off, then we'll hit up questions there. You can set a target if you want. Just like with a lot of stock trades, maybe a shorter term stock trade, you're more likely to set a target. Some people let stocks just run and don't necessarily set a target. Set profit target. Okay. And then I think I have one more. I had a list. I just kind of wrote them out. Two more, I guess. There is an expiration date. Exit less than, we'll say 10 days to expiration. Remember, theta is not really working against you on this, days to expiration, but also remember, short options can be assigned at any time before expiration. And in this case, we're talking about short options. And then finally, in terms of money management, we'll say 1 to 2%. And these are just, this isn't recommendations. This is just how we do it in this class typically. 1 to 2% of active trading portfolio, okay, in terms of the risk that we're planning on. Now, as stops aren't guaranteed, our exit aren't guaranteed, so we don't know exactly on that risk there. Okay, let's hit up questions. And then let's look at some examples here, okay? So why should we be, the reason why we're going to get out is we don't want to hold. So question from Eden, which is a good question. Why do we exit before expiration? Well, come expiration, you're going to have assignment or exercise on that, on one or the other there. And so we're just trying to avoid that happening. You don't have to go 10 days, but the closer you get to expiration, the bigger the chance of early assignment, generally, okay? The closer you get to expiration, the bigger the chance of early assignment there. Okay, so let me just hit up questions here. So, question, even if my trade is cash secured, in order to do a short put or a short call, yes, you need the higher level options approval there. Okay. Well, actually, I take it back. In the case of a short put, if it were covered, if you do a covered put, the options approval level may not be as high. So that may be a distinction there on that. In the case of a short call, it doesn't matter how much money you have in your account, because it's a theoretically unlimited risk, you would need the higher level options approval level. With the exception of that would be if you did what we were talking about earlier and adding on a long call at a higher strike and just turning that into a vertical spread. But that's not really what we're talking about there. So good questions. Barb, thank you for helping me out on those there. And I think, okay, can I scroll up? There's all my notes right there. Okay, there's my notes. If you want to take a screenshot, I would not stop you on that one there. Okay, so what I want to do is let's go to the Thinkorswim platform. Let me just move this here. I can go back to it later if you guys need that. But I want to go to the scan. I'm going to go to Spreadbook. On Spreadbook, they don't have anything called synthetics. Okay? I don't have anything called synthetics here. And I'm going to go to combo. Okay? I'm going to go to combo. And so you can kind of look, you can scroll down for a synthetic. So for example, remember, same strike, call put, same expiration, same strike, short call, long put. What is this? What's this trade right here on NVIDIA? Well, let's take a look. Short call, long put. That's a short synthetic. Let's analyze the trade. Okay, what does this look like? This looks like what we were looking at before. So this person, okay, this trader, whoever did this, basically is taking a bearish approach to NVIDIA. Now, it's possible this was a closing trade. Okay, so I don't know for sure. But if this were an opening trade, this would be a bearish trade on NVIDIA. That's what we're looking at here, okay? Let's look at some of our own examples here, okay? So I'm not going to do NVIDIA. We just saw an example of that. I'm going to pull up Oracle. And a synthetic, so let's take the long synthetic approach, okay? So think about it. It's kind of trying, even though it's different than buying stock, it's trying to replicate it in a sense. So in terms of your entry signals, what are the things you're probably going to look for in terms of entry signals? Well, you're going to look for the same stuff as stock. Well, for technical traders, that usually comes down to trend. It may come down to support and resistance. It may come down to indicators or price action. So here we go. We had a low on Oracle back here, bottomed out along with a lot of the market. Slightly higher low. We've now established a new low and another higher low. We have, 3 higher lows after this. We had a potential resistance, I think, about this level. We broke above it briefly, and we bounced off it right there. We bounced off that right there. Kind of like a little flag pattern almost. That's positive. We broke above the 20-day and the 50-day moving average. Now, so for our purposes, I'm going to call that bullish. Okay? So for our purposes, what I want to do is I want to do a long synthetic on it. Now remember, with long synthetics, because it's like trading stock, except we're not going to be, there's an expiration date, no dividends, we're not going to be entitled to dividends. It's going to be a much lower cost initially on this. Oracle would normally cost me for 100 shares of stock, $150 times 100. That's $15,000 for 150 shares of ORCL. ORCL, that's supposed to be an O, even though it doesn't look like it. There's an O. Okay, that's how much 100 shares of Oracle stock would cost. Okay, this, I'm not planning on spending much out of pocket on this trade right here. There'll be a buying power effect, but I'm not planning on spending much. But I'm planning on getting the same price movements as if I bought $15,000 worth of Oracle stock here. So if Oracle goes up from 150 up to 170, for example, $20 move on Oracle, that would normally be $2,000. We could still look at potentially a $2,000 gain on the short synthetic without spending that $15,000 up front. What if it goes against us? If it goes against us and it goes down from 150 down to 130, we'd lose approximately $2,000. There's that leverage there on that. All right, so let's do this. Let's take a look. I'm going to go out to Oracle, and we got to decide, how long. And I'm going to take a kind of a longer term approach on this. So I'm going to go to trade. I'm going to go out. I'll go out 70 days. Okay, that's over 2 months. Not super long term. You can go out longer. Look, I can go out to June of 2027. Wow, that's crazy. June of 2027. And even if you do, and you're going, well, those are going to be expensive options. Well, they would be expensive options, but remember, you're buying and you're buying your calls and selling puts, which are going to largely offset each other. Okay. But here we're I'm going to go at the money, just as we kind of mentioned. I'm going to go 150 strike. I'm going to buy the call. I'm going to sell the put and hold down my control key. There we go. Costs a little bit. It's going to cost us about $100. Okay. Kind of scrunched down there. About $100, maybe just a smidge more. Okay. A little bit more than $100 maybe. As opposed to $15,000. Okay. Let's confirm and send this for a sec. I'm not going to send it quite yet, but I want you to just look at this. Max profit infinite. Don't get too excited. Anytime you buy a stock, theoretically, there's an infinite max profit on that. And we're not buying stock here, but that's what you see. I doubt any of you have an infinite amount of money, so therefore it probably means that, that just means it's potentially, you can make a lot of money on this if it goes up. What's my max loss? Well, 15,000, that seems like a lot. Well, yeah, but that's really not any different than if you bought 100 shares of Oracle stock and the stock went down to zero. You would lose about $15,000 on this. Okay, it's going to cost us about $100. Break even is going to be just about, the $100 above basically where we're at right now. And there is the buying power effect, okay? And so that's roughly 20% or so, I don't know, ballpark, of what our initial cost is. Actually, I guess that's closer to 30%, okay, of our initial cost. Buying power effect. So we can't just do this without, and not, this keeps you in line. It's easy to look at a market and go, that's potentially a big gain. I want to make a lot of money. I just want to do more and more of these. Well, that's a problem. You have to have that. Okay. Now, if I decide I want to get out, I'm going to call it a stop. It's technically going to be a rules-based order on this. I'm going to decide, where am I going to get out on this? I'm going to say, look, I've got a support level. I'm going to assume that maybe we have a support kind of in this range here, right about there. If we break down on this and it goes against us, we'll give it a little wiggle room, just like we would a stock. But if we hit this support, we'll give it a little wiggle room even below the support level there, okay? And so let's say I'm going to get out at, I don't know, 139 or something like that, okay? You can add that exit in there. So, but consider your risk. Remember, how much am I losing if the stock goes down to 139? Well, right now, I'm just going to kind of round, the stock's at 150. 150 minus 139 is $11. Times our multiplier of 100, that's $1,100. So make sure that's within your risk tolerance, okay, of the trade, your trade plan, of your portfolio, and whatever your plan is on that, okay? So 139, we're going to put that trade in. I'm going to put an exit order in here. I'm going to change this to first trigger sequential. I'm going to right-click on this. I'm going to create an opposite order, and I'm going to make this a market order. I'm going to make this good till canceled. Now, does this mean we're going to get out right when this stock hits 139? It doesn't. We don't know exactly. Just like with stops where they're not guaranteed, this does not get us out guaranteed to be right when the stock goes to 139. Stock may gap down. Maybe there's terrible news with Oracle and it gaps to $110 or something like that. It's possible. Okay. I'm going to save that. I'm going to look at this and just see. I'm going to move this up just to make sure we get filled on that. And I'm going to confirm and send. And I'm going to put this in our synthetics category here. Okay. I'm going to send that. And we just sent it. Okay. Hasn't filled yet. We'll see if that fills. If it doesn't fill by the time we're done today, I may adjust the price just a little bit to see if we can get in. But if I look at Oracle here, let me go to Analyze tab, and let's look at, well, it's not filled, so okay. Let's move on. Let's look at short. We're getting a little lower on time, so let's look at a potential one that maybe hasn't turned around quite as much as others. Here's a company that has struggled a little bit. And the company is Starbucks. They brought in a new CEO, hoping to turn things around. So far, not really. Things haven't really brightened up that much for Starbucks at this point. Okay. From a technical standpoint, we kind of have this downward trend here that we've seen. Kind of been a little bit more flat of late. Shorter term trend, more flat. More intermediate, we're going to call that down. We're below the 20-day moving average, kind of bouncing off that almost, below the 50-day moving average. And we had this it's been kind of this big flaggy pattern type thing of that, and then this, and then this. And my plan is, hey, this may repeat this kind of drop here. Now, you may do that, and so you may put in a target price on it. Regardless, you can put in a target price, but we're probably, and for our purposes, we're going to put a stop in on these, okay? So my stop is going to be above my resistance, which is about 85. So we'll say about 87. Let me just jot that down. 87. I'm calling it a stop. It's just a rules-based order to get out on that. This went from about 100 down to about 80. So I'm going to put a target price from our high to low, about 65 target. Okay. Let's do, let's go here. This is a short synthetic. We're bearish on this. Remember, there's a theoretical unlimited risk on this trade. I don't have to go out as far. You can go 42 days, you can go whatever. I'm going to try and stick with more liquid contracts. I'm going to buy the put at the money, basically, 405. I'm going to sell the call at the money. Hold down my control key. Long call, excuse me, long put, short call. We're going to right click, create an opposite order, put it in my gear, click on my gear. Actually, we're going to make that market good till canceled. And we said, what were our rules? We said if Starbucks marks less than or equal to 65, that would be a good scenario. Remember, we want it to go down. Or Starbucks marks greater than or equal to 87 is going to get us out. That should preserve a decent reward to risk ratio on this trade. From assuming we get out if it goes above 87. Again, no guarantees on that, and there is a theoretical unlimited loss on this trade. See that max loss infinite? Kind of scary when you see that. As we mentioned before, if you want, you could put in an additional, say, long call at a higher strike price to try and help protect yourself. But just know the risks that you get in when you trade, folks. I think I've emphasized risk quite a bit today. I don't do that to scare you, but I want you to be fully aware of what is at stake when you trade here. That's a bearish trade. That one just filled. And so we're in that one. We're just about out of time, but oh, the other one just filled too. Okay, so we're in both of those synthetics. And management. Remember, we're managing these like stocks. You know, we did a synthetic before on CVS. We did this synthetic and we got in on the 16th. We're down a little bit of money right now. Not terrible. Well, let's look at CVS. This is a synthetic we got in on April 16th. Okay. Well, where was April 16th? April 16th, hold on. April 16th was right there. This day right here, we got in, okay? I don't know exactly where in the day we went, but look what happened. The stock, you know, just went down a smidge, I think, on that. And is there any reason to get out of this? Well, look, if this is a trade where I was thinking like a short-term trend, it's not trending up. But if this is just a longer-term approach to the market, then there's nothing, it's not seriously breaking down either. And so I think you could certainly justify staying in that trade there if you wanted to on that trade from that standpoint. Up to you. Have your exits in mind there, and we do have exits on this trade here. One other thing, we held it. We didn't get the dividend because remember, with synthetics, you don't get dividends. All right, everybody, I am just about out of time. Let me just see, is there any last questions I can fill out for you or answer for you? You're buying a put, isn't that a long put? That was a long put on the short synthetic, you have a long put. Yep, absolutely, NK. For a short synthetic, you're doing long puts, short calls, okay? Because that's the bearish trade in that case, if that's the trade you were talking about, okay? And Barb, thank you for helping me out with questions. As I think I got them. I hope I didn't miss any. I think we got them between Barb and myself. Everybody, coming up next, we have ThinkScript studies. Check that out. Thanks for joining me today, and have a wonderful weekend ahead. You have a couple more tools in your arsenal. I'm kind of mixing metaphors, aren't I, right now? A couple more weapons in your arsenal, your advanced options arsenal there. So have a great day, everybody. Thanks for joining me. Bye-bye, everybody.